All right, let's talk Sea Limited. Their latest earnings for Q3 2025 just dropped. And wow, on the surface, it looks like they were firing on all cylinders, right? But the market had a completely different take. It's a real head-scratcher, so let's dig in and figure out what's going on.
So the earnings come out and bam, the stock plummets over 8%, just like that. A really brutal reaction. So you've got to ask yourself, what on earth did investors see that made them hit the sell button so hard, especially when the report looked, pretty darn good?
Okay, so this is where the plot really thickens. It's a classic tale of two numbers. On one hand, you've got revenue. They brought in $6 billion, which actually beat what everyone was expecting. Great. But then you look at the bottom line, the earnings per share, or EPS. That was a huge miss. They were supposed to hit $1.03, but they only managed 59 cents. And that right there is the whole story in a nutshell. A nice revenue beat completely wiped out by a big miss on earnings.
But, those headline numbers don't tell the whole story, not even close. If you actually peel back the onion and look at how the business is operating, things look incredibly strong. All three of their main divisions, they all had fantastic momentum. So let's break it down, piece by piece.
First up, you've got Shopee. This is their e-commerce powerhouse, and man, did it have a record-setting quarter. Check this out. Gross merchandise volume, that's basically the total value of everything sold on their site, hit a staggering $32.2 billion. That's up more than 28% from last year. And total orders? They grew right alongside it, also up 28%. This wasn't some random fluke either. It was because they're getting more active buyers, and those buyers are coming back and shopping more often. That's exactly what you want to see. Okay, now for Garena, their digital entertainment and gaming division. And this was an absolute monster quarter. Seriously, their best since 2021. Bookings just skyrocketed, up over 51% to $841 million. And what's behind that? Well, it was all powered by some super successful campaigns for their smash hit game Free Fire. We're talking collabs with huge names like Naruto and Squid Game. This is the engine, the cash cow, that's funding a lot of the growth in the other parts of the business.
And to round out the big three, we've got SeaMoney, their fintech business. Revenue here didn't just grow, it exploded. We're talking up nearly 61% from last year. And their loan book, it ballooned by an incredible 70%, all the way up to $7.9 billion. Now, you might think that with that kind of crazy growth, their bad loans would be piling up, right? Nope. Their non-performing loan ratio held steady at a super healthy 1.1%. That's disciplined, smart, rapid scaling right there.
So that brings us right back to the million-dollar question, doesn't it? You've got record e-commerce sales, a gaming division that's on fire again, and a fintech business that's absolutely booming. So why in the world did the stock get hammered?
Well, the answer really comes down to that classic Wall Street tug of war, growth versus profitability. It turns out the market was looking for one thing, and Sea's management was playing a completely different game.
Okay, so here's exactly why investors got spooked. That big earnings miss we talked about, that was the #1 culprit. And the reason for the miss wasn't because the business was failing, it was because they deliberately cranked up their spending on sales and marketing. The market was expecting them to focus on profit margins, to show that they could be more efficient. Instead, they saw costs going up. And then, to really throw fuel on the fire, management said, oh, and by the way, we're not giving you any profit guidance for the rest of the year. That was a huge signal that they plan to keep the spending taps wide open.
But now let's flip the script and look at it from inside the company. The CEO, Forrest Li, was super clear on the earnings call. He said their focus is on delivering, quote, high and profitable growth. Now listen closely to that phrase. The key word that management is focused on is growth. They're playing the long game here. They're willing to spend and spend big right now to defend their turf and grow their market share. The bet is that this will lead to way bigger profits down the road, even if it stings a little bit in the short term.
And this right here really lays out their strategy perfectly. Look, they're so confident in their growth that they actually raised their full-year targets for Shopee and Garena. That's a huge vote of confidence in the top line. But, and this is the big but, by holding back on any kind of earnings guidance, they're basically telling Wall Street, we are not going to be chained to a short-term profit number. We're going to spend what we need to spend to win this market.
So where is all this money going? It's not like they're just throwing cash into a bonfire. No, it's very strategic. They're pouring it into key areas to build a real fortress around their business. They're beefing up their logistics network to create an unbeatable delivery advantage. They're scaling up their Shopee VIP program to make their customers super sticky. They're weaving AI into everything to make the platform smarter and more efficient. And maybe most importantly, they're in an all-out war to defend their market share from some really aggressive competitors, like TikTok Shop and Lazada.
All right, so that's the lay of the land. The big question is, where do they go from here? Let's get into our take on Sea Limited's path forward.
So after weighing everything, we're landing on a market perform rating for the stock. Here's why. The growth story is absolutely the real deal. It's powerful, it's undeniable. But the stock itself is probably going to be stuck in a holding pattern for a little while. Investors are just really sensitive to this spending issue right now. And until the company can show a clear path back to expanding profit margins, it's just tough to see the stock taking off and crushing the rest of the market.
But if you're looking at this from a trading angle, here's a potential idea. The core thesis is that the market is just being way too short-sighted. It's punishing the stock for these investments, and maybe, just maybe, it's missing the massive long-term growth engine that's being built. That 8% drop could be an overreaction. Now, what could change the story? You'll want to watch for a few key catalysts. Did they get a good return on their holiday season promotions? Do we see marketing spending start to level off next quarter? And can Garena keep up its incredible momentum? Of course, there are risks. The competition could get even tougher, the loans at SeaMoney could start to go bad, or Garena's hot streak could cool off. Those are the things you have to keep an eye on.
And as always, just a reminder, this is not financial advice.